Our assumption is over the next, say, 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s
Oh, wow.
in the surge, this surge. Now,
Yeah.
that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning, I think you could see us well above the old 50 highs up into the 60, 70 zone before you even pause, fold. And I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50,
Yeah.
which is, they're sucker highs. They're ridiculous. In
Yeah.
real dollar terms, we'd have to be probably $200 or 300 just to match those.
The precious metals market is witnessing renewed optimism around silver, with prominent analysts forecasting significant price advances over the coming quarters. Market analyst Michael Oliver, known for his momentum-based forecasting approach, believes the current silver rally is far from over, projecting prices could extend to $60 to $70 over the next 2 quarters. Importantly, Oliver emphasizes that this anticipated move represents just the next phase, not the peak, of silver's broader bullish trajectory. The broader analyst community shares this bullish sentiment, with spot silver emerging as an increasingly popular investment choice. Experts are now forecasting prices climbing to $60 per ounce, though they caution that patience will be essential for investors. Some analysts are even more aggressive in their projections, predicting silver could double to $70 by year-end, citing the metal's persistent undervaluation and growing concerns about the fragility of the global financial system. While some analysts mention $300 as a potential ultimate high for silver, most forecasts focus on more moderate but still substantial gains in the $50 to $100 range. Oliver's analysis carries particular weight given his perspective on silver's recent technical developments. He views silver's pause near $37 as a significant milestone, marking a decisive break above key resistance levels around $35. Oliver distinguishes between genuine market peaks, which typically form with sharp price spikes, and what he describes as the gaseous 2011 high that quickly collapsed after reaching $49.21 per ounce on April 29, 2011. The historical context adds weight to these forecasts. Silver's dramatic rally in 2011, which pushed prices to a 31-year high, was driven by concerns about monetary inflation and questions surrounding government solvency in developed nations, particularly within the Eurozone. These underlying macroeconomic tensions bear striking similarities to current global financial uncertainties, suggesting similar catalysts could drive silver's next major advance. Before we dive in, make sure to subscribe, hit the bell icon, and share this video. Your support helps us deliver more timely insights on gold, silver, and the markets.
Yes, I think miners are a better place to be than gold. I think they could double or triple the performance of gold over the next year or two, which whatever gold does, triple that on a percent basis for miners. And
Yeah.
there's technical reasons for that. And I think silver could outpace them both, big time, on a percentage basis. In fact, I think this move in silver right now, you paused here at 37, which of course has taken out a bunch of highs. Yeah, you can see the distribution highs up there at 35, 35, 35.
Yeah, yeah,
You,
yeah.
you don't ultimately top that way. You might pause there, but you don't top. You generally spike when you make a major high. You go back to the 2011 high, it was gaseous.
Right
You
here.
didn't, once you made that high, you collapsed. You never get back to the high again.
Yeah.
I mean, you collapsed the first few months off the high, came back, but you could never get back to the high.
Yeah.
And it was gaseous. It was hardly even a high. The reality up there above the mid 45 level or something, it was temporary. This time we've just come out of congestion, and you'll notice if you draw a line through the lows in 2011 and 12, where silver pulled back to about 25 there, going up, the lows that occurred, right there.
Oh, right. These ones right here?
Yeah, right there.
Okay.
Find the low close in there. Go up a little bit further. The low monthly close in that zone. You'll see a bar there. You go up a little bit further. Take that
Uh,
line up, your line up. The red line's there. Right up a little bit. Take it
uh,
up. Yeah.
this one?
No, take it down some now. Right about the stop. Yeah. Move
Okay.
your solid line up a bit.
Low is 26.10.
No, the close. You'll notice the
Oh, the
month.
close is 27.
Yeah, when if you look over to the left, you'll see another close at about 27 something.
27.75.
Yeah, I know. Or even back and further, there's a bunch of closes there. Now, if you go horizontally, look at the recent action. Look where that line intersects. We stopped basically at that upper 20s repeatedly there in the
Yeah.
2021, et cetera. Finally broke through it. So you
Yeah.
broke through a price level even that said, hey, man, wake up. You just went through a major pivotal zone. And
Okay.
again, we're not behaving like a blow off top. We're just emerging from congestion. Our assumption is over the next, say 5 months or so, next 2 quarters, you're going to see silver in the 60s to 70s
Oh, wow.
in the surge, this surge. Now,
Yeah.
that's not the top. I'm not arguing that's a top. I'm arguing in this particular surge that is just beginning, I think you could see us well above the old 50 highs up into the 60, 70 zone before you even pause. And about, if you'll look there at about, half a dozen months, you left the earth. Okay, now then you topped. I don't think that's going to happen this time.
Okay.
I think
Okay.
you're gonna. I've got friends and associates that think you go to $200 wouldn't shock them, and they're fundamentally astute folks. I won't mention their names. You probably know them. I fully agree, but right now I'm just looking at this leg that is beginning to unfold, and I think it's going to blow past that silly high at 50 and the other high back in 1980 at 50, which is they're sucker highs. They're ridiculous. In
Yeah.
real dollar terms, we'd have to be probably $200 or 300 just to match those highs
Yeah.
in a real
Yeah.
dollar. But right now, I see an open window for a massive run here on a
Yeah.
percentage basis. So this is why we're keen on silver and the miners. They're very, very cheap in relation to gold, and there's technical reasons to assume they're turning up on a relative basis. So right now, looking at gold, yeah, up, but you don't want to be in gold. You want to be in the silver and the gold and silver miners.
Okay. Okay. This goes right in line with
Market analyst Michael Oliver identifies an unprecedented opportunity in precious metals mining stocks, with the XAU to gold spread showing extreme undervaluation not seen historically. His analysis reveals that despite miners outperforming gold since the 2015 to 2016 lows, current valuations suggest the sector faces either total collapse or sharp upside reversal. Historical precedent supports this assessment. After December 2015 bottoms, mining stocks rebounded dramatically, substantially outperforming underlying metals through the first half of 2016. This pattern demonstrates the sector's ability to amplify commodity price movements during favorable conditions. The investment dynamic is straightforward. While gold offers stability and steady returns during downturns, mining stocks deliver superior gains during bull markets through operational leverage. However, this same leverage creates higher volatility and deeper drawdowns, making timing and conviction crucial for success. Oliver's analysis suggests mining stocks are approaching a pivotal resolution of their extreme undervaluation. The combination of historical outperformance patterns and current valuation extremes creates potential for significant returns, contingent on navigating the sector's inherent volatility. For investors monitoring precious metals markets, the mining sector's leveraged exposure to any sustained rally demands close attention.
Let's get back to the interview.
We measure the XAU index, Philadelphia Gold and Silver Miners Index. It goes back to the 1980s. If you can punch it up in price, that'd be fine. We're looking at a spread of it, actually, but that's fine. Just go to the price chart. XAU index. Okay.
about like that.
Yeah. Well, back even in the 1980s through 2000, through that clump of ink there, a couple decades.
Yeah.
If you divided the price of XAU into the ounce of gold, you would see that the price of XAU was at 17.5% to 35% the price of gold. So while price oscillated there,
Spot here.
this is a spread chart. Okay, now this shows the monthly range of XAU expressed as a percent of the price of an ounce of gold. You'll see that from 1984 through 2004, 20 years, it basically lived in a range either side of about 25%.
Yeah.
Got up to 35 one time, multiple times up near 33, and it made a bunch of lows there at about 17 and a half.
This is 25% right here. This
Yeah,
way.
okay, drop down to 17 and a half now.
Okay.
Drop that white line. Drop that white line down there. Yeah, right there. Not the that. Leave it there. There you go. Now that line is the bottom end of a multi-decade range of performance of relative value of the miners to gold. That's the bottom end of what really is a 2.5 decades of price action, the spread action. You collapsed in 2008 through 15, and that spread bottom coincident with the actual bear market lows in gold and the miners in late 2015. And since then, the spread is higher than that.
Yeah.
Now, this is ludicrous because we're only at 6% now, and that low is about 3.5.
Yeah.
But that means that actually the miners are at a higher level now than they were 10 years ago. So if you hit the bear low in gold in 2015, or let's say in February 16 when we said go long, if you'd have bought miners instead, you're actually doing better than if you bought gold. Hard to believe because price doesn't look like it, but the spread says no, you've actually gained some ground. Now, forget that. you're still at historically low levels.
Yeah.
This is like free. Are you going to go to zero? Okay. If you saw a price chart that looked like this, you'd say, well, it's either going to zero and go bankrupt, okay, the company, or it's the bottom. Okay. Well, you're not going to take the mining industry bankrupt. Okay. So you look at that base now, rise up to about 8% there on that lower line.
Okay, about 8%.
Yeah, right there. Now
Okay.
you see there was a low and then multiple highs at about 8%. Right now
Yeah.
so we're about 2% away from the upper end of the base. We're seeing enough technical evidence now in that spread. We got to get in real close to it. Don't do it with your chart. No, I'm talking about we're using weeklies and everything on the
Okay.
spread that show that we're turning up now and likely to assault the top end of that range. We think that's highly likely and probably wouldn't take long. If you ever break the spread out of the top end of that basing action, treat this as a price chart. Where's resistance? 17.5%.
Yeah.
Okay. The old floor, which was a multiple floor and also the rally highs you saw in 2009, you get up to that 17.5 and failed there. 2009, yeah, you failed there.
there.
So it's pivotal. It's very, very pivotal.
Yeah.
Well, we're at 6%. If you go to 17.5, what's that? That's called a triple.
That's a 3x. Yeah.
Yep. Okay. That means you stand a chance here if you move this thing up a bit and ever take out that 0.8% level,
Yeah.
even go back there again. I wouldn't want to see it if I were a bear. You're likely to blow performance out and produce a rally up to there. And you say, oh, so what? Well, that's a triple. That means if
Yeah.
you bought a basket of miners, you're going to do 3 times better than if you bought gold. And by the way, this spread does not go up when gold is going down. This spread, when it turns up, means gold's also
Gold and silver continue to demonstrate their strength as both defensive assets and vehicles for growth. As prices recover from multi-year lows and break through key resistance levels, the current momentum suggests further upside. With historical patterns indicating room for significant gains, gold and silver remain central to strategies seeking both protection and performance in today's shifting financial landscape. Will gold and silver break new highs? Let us know your thoughts in the comments below. If you found this video helpful, don't forget to like, share, and subscribe for more insights on the precious metals market. Thanks for watching and see you in the next video.